Global markets are oscillating, in tune with their views on when the Fed can cut, and it's still not clear. We look ahead to Australian inflation data on Wednesday and New Zealand's budget on Thursday. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks into what China's recent property market support package could mean for steel demand and the iron ore price.
The reinvigoration of new projects will still take some time, really, when that unsold inventory gets whittled down to sort of normalised levels, and that could take a couple of years.
But first, in 5 and 5 with ANZ, markets are wobbling back and forth in line with mixed signals from the US economy about whether and when the US Federal Reserve can cut rates. US bond yields were mostly flat on Friday, while stocks rose as much as 1%. Currencies also meandered about. Here's ANZ Group Chief Economist Richard Yetzinger on the ups and the downs of trying to work out where the US economy will go next.
A lot of people are struggling to work out where we've come from, in all honesty. It's been 4 seasons in a week. At least it kind of feels like that. I keep reminding people mid-cycle slowdowns are interest rate purgatory. This is what they feel like. The data is a bit in one direction and then a bit in the other. And again, that's what we've seen most recently with some stronger PMIs taking market pricing back towards the more hawkish side. There's no doubt that activity, particularly in the US, has held up better than many people thought and a bit better than we thought. In the week ahead, though, we get some key readings on prices, and ultimately it's the prices that will drive what the Fed does.
Number 2, the big data globally this week is US personal consumption expenditure inflation data. That's due for April on Friday night, after less closely watched US GDP data. Richard previews the numbers.
The US economy has surprised on the upside in activity terms, and it continues to do so. So GDP out before that will set a bit of a tone, but the Fed ultimately will be driven off the inflation indicators, and PCE is the next cab off the rank. There has been this gap between PCE and CPI of nearly 1%, so this data probably won't help us resolve that, but the market will take incremental information from whether or not there's evidence in there that disinflation is gradually continuing, or in fact has it stalled, which is what you could read out of the CPI data.
Number 3, Australia's monthly CPI data is due on Wednesday. Richard takes a look ahead.
The monthly CPI, the market will latch on to this one, even though it is an experimental, really, monthly CPI indicator. Not all of the basket is updated each time this indicator is released. But of course, after the Reserve Bank's recent signalling, and in fact the last inflation number that was a bit hawkish, the market will take information from this release. We're expecting a slowdown in the year-over-year rate of inflation from 3.5 to 3.4, which I think is, if that's what we get, is probably a reasonable indication of where the disinflation process is at in Australia. We came down quickly from 7.5 to below 4, and then from 3.5 to 2.5 is going to take us some time.
Number 4, European inflation data is also due on Friday. The European Central Bank is on track to cut before the Fed, and as early as next month. Here's ANZ Head of G3 Economics, Brian Martin.
The last thing the ECB will want is for price indices to start dropping into levels that are consistent with a contraction in economic activity. They had spent years between 2010 and 2017-18 fighting deflation. They're not going to want a re-emergence of that. So I think these data do suggest they need to cut interest rates.
Number 5. The big news in New Zealand this week will be the new government's first budget on Thursday, where the details of promised income tax cuts are likely to be revealed. ANZ senior economist Miles Workman says it's not clear the tax cuts, which have been signalled as modest, will boost economic activity.
So we're not expecting a huge income bump for households. And then at the same time, you have to remember that because households are quite cautious, well, those who can save some of that probably are going to. So there's going to be some leakages in terms of how this flows through to demand. Yes, you could argue that the targeted nature of these tax cuts are towards people who are generally lower income and therefore have a higher marginal propensity to consume. However, there will be some expected leakages via that savings channel and also via imports. Would think that the household consumption basket is probably a bit more import heavy than the government's. So dollar for dollar, if you're taking away from government spending and giving to households, there's probably going to be a bit more imports than otherwise. And that's a bit of a drag on economic activity.
Miles Workman there. Now, in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes digs into China's recent property market support package from a commodities point of view.
When you look at it from a commodity perspective, you do have to look at slightly different sort of issues. And certainly for steel and iron ore, it's all about new construction activity. The property sector itself has been weighed down by this huge amount of inventory, and property developers have clearly been under financial pressure as well, carrying huge amounts of debt. So that has clearly weighed on house prices, and demand has been weak. But for commodities, we were looking at how, I suppose, these latest measures would reinvigorate new demand. Now, from what we can see, the latest measures they've rolled out are really only going to result in a lot of the unsold inventory being moved and utilised, and certainly some of the unfinished projects or near completed projects that have been stalled due to financial distress from the developer. So that clearly will benefit sentiment in the sector, but it's not really going to invigorate new projects, which will obviously then result in a rebound or a recovery in demand for iron ore and steel. So from my perspective, that was sort of the key takeaway, that we need to see more demand come through for housing, which probably won't happen in the shorter term amidst the broader sort of structural headwinds that the sector is suffering from.
So with that new focus on social housing, how does that change the steel intensity versus other types of house building?
Yeah, and within these latest support package, they've looked at obviously local governments purchasing some of that unsold inventory and then turning it into social housing. So that's the first phase of that. That clearly could impact future demand, because there was targets set to bring in social housing or affordable housing, which previously was going to be undertaken via new projects. Now that may look like coming through in terms of purchasing already completed property which has remained unsold. So for a start, that'll impact future demand. Secondly, as you highlighted, the steel intensity of use of social housing is significantly less than in the broader sort of private sector. And so that ongoing long-term sort of focus on providing affordable housing will ultimately lower demand for steel and iron ore within that sector as well.
So what do you expect in terms of investment or new property investment over the next year or two? And how does that affect demand for steel and iron ore?
Yeah, look, it's still going to be a fairly challenging environment. Certainly, these measures are likely to have stabilised the sector, and developers may not go under in the way we've seen in the past. So that's going to be a positive. But certainly, as I said, the reinvigoration of new projects will still take some time, really, when that unsold inventory gets whittled down to sort of normalised levels, and that could take a couple of years. So in the meantime, we do expect to see investment in property remain relatively subdued, which will impact steel demand from the sector.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ from Monday, May the 27th. Catch you tomorrow with detail from data due later today on China's industrial profits for April, which will tell us about their economy. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.